All right, let's dive in. Today, we're going to follow the wild journey of a single dollar bill. And believe me, it's a story that takes us from the super abstract world of high finance all the way down to the split-second decisions of market traders. So let's track its path right from the very beginning.
I mean, really think about it. That dollar you just used for your coffee, where was it yesterday, a year ago? Its story is really the story of our entire economy. So we're going to follow one from the moment it's born. Okay, so where does this dollar's life even begin? Well, it doesn't start in a gold mine or a printing press. Not really. It starts as an idea, just a piece of data created by a central bank. To really get its journey, we first have to wrap our heads around what it is. And right away, we hit our first big concept. Our dollar is what's called fiat money. Now, all that means is its value doesn't come from, a pile of gold or silver locked in a vault somewhere. Nope. Its value comes from something way more abstract. Basically, our collective trust in the government that issues it. Some economists are super blunt about it. They call our money intrinsically worthless. Its entire power just comes from this shared social agreement. You accept it as payment only because you know for a fact that you can turn around and use it to pay someone else. It's really just a story we all agree to believe in. Kind of wild, right? So how does one of these dollars actually pop into existence? Well, it's through this thing called fractional reserve banking. It works like this. First, the Federal Reserve basically creates money out of thin air digitally and lends it to a commercial bank. That bank has to keep a small piece of it, a fraction in its reserves, but the rest, it can lend it out. And that new loan gets deposited in another bank, which does the exact same thing, keeps a little, lends out the rest. And through this cycle, that initial loan just gets multiplied over and over, expanding the entire money supply.
All right, our dollar is born. So now what? Well, it doesn't just sit around. It gets pooled with billions, even trillions of others in the financial system. And that's where the next stage of its adventure really kicks off. So let's imagine our dollar gets deposited and finds a new home inside a university's endowment fund. Now, this isn't just some big savings account. Think of it as a massive investment portfolio, but one with a very special, very long-term mission.
Yeah, the whole philosophy behind these funds is pretty unique. They operate on what they call an infinite time horizon. I mean, they're designed to last forever. And the big goal here is something called intergenerational equity. That's a fancy way of saying they have to balance supporting students and research today with being able to do the exact same thing 100 years from now. They literally think in centuries, not financial quarters. Okay, but to hit those super long-term goals, the endowment needs serious growth. So it takes a piece of its funds, our dollar is in there, and gives it to a private equity firm. And that firm uses this cash for a pretty complex move called a leveraged buyout, or an LBO. Basically, this means they borrow a ton of money to buy an entire company using that company's own assets as the collateral for the loan. So how in the world does an LBO actually make money? Well, it really comes down to three main things. The biggest one, about half the value, comes from EBDI growth. That's just jargon for making the business run better and increasing its core profits. The second piece is multiple expansion. Think of it like this. You buy a company when it's valued at, say, 5 times its annual profit. A few years later, you sell it when the market says it's worth 8 times its profit. You've expanded the multiple. And the last part is pretty straightforward, debt paydown. You just use the company's own cash flow to pay back the loan you took out to buy it in the first place. But here's the thing. This massive LBO, with billions of dollars flying around, doesn't just happen in a vacuum. It's all governed by this incredibly complex web of legal and tax rules, these invisible structures that our dollar now has to navigate. One of the most fundamental tools they use is something called a trust. It's just a legal setup where a settlor gives assets to a trustee, someone to manage them, for the benefit of a beneficiary. In our story, the university endowment is the beneficiary. It's a really clever legal way to separate who owns the assets from who controls them. Now, the legal rights inside a trust are super strong. But what happens if assets get sold when they shouldn't have been? Well, there's this really important legal principle that protects an innocent buyer, what the law calls a bona fide purchaser for value without notice. Basically, someone who pays a fair price without knowing about any shady business in the background. This rule is absolutely crucial for keeping markets moving, making sure that huge deals like our LBO can happen with some level of confidence. And the complexity of these rules can be just staggering. I mean, let's take something like the income tax. The common understanding, the one we all operate on, is that it applies to all income, based on the IRS code.
But just to show you how deep the rabbit hole of legal interpretation goes, there are some analyses out there that argue the tax code was only ever meant to be an indirect tax on specific types of privileged income, like from foreign sources. Now, that is definitely a dissenting view, but it's a perfect example of how the very rules governing our dollar's journey can be fiercely debated.
Okay, let's fast forward. The LBO was a huge success. The endowment gets its profits, which helps fund its mission for another generation. Some of that money trickles back into the economy, maybe as someone's salary. And now, a tiny piece of it, our dollar, has landed in the hands of an individual day trader. And here, the whole game changes. The time horizon shrinks from decades down to minutes, even seconds. To a trader, a number like this one, 1.272, it's not random at all. It's a key ratio that comes from the Fibonacci sequence, that famous mathematical pattern you see all over nature. Technical traders use extensions of this ratio to try and project where a market's price might be headed next. It's their tool for trying to find some kind of order in what looks like total chaos.
So, how do they actually use a number like that in a real strategy? Well, a trader might spot a specific zigzag pattern on a price chart. Then, they'll use that 1.272 ratio to project a potential price target, an entry point. But they don't just jump in. They'll use other tools like moving averages or momentum indicators to confirm the signal and time their trade. And just like that, in a split second, our dollar becomes a bet, a wager placed on the belief that a mathematical pattern from the past will repeat itself. So, wow, we followed our dollar from being just a concept in a central bank through a 100-year endowment fund into a massive corporate buyout and all the way down onto a single trader's screen. It's been a store of value, a unit of account, and a medium of exchange, which, it leaves us with this one big question. After seeing all that, what is money really? Is it a tool? Is it a system? Or is it maybe just the most powerful story we've ever told ourselves? After following its journey, the answer is anything but simple. That's something to chew on. Thanks for joining me on this one.